Good morning. Welcome to today's webinar on lifetime allowance dilemmas and pension death benefits. My name is Lisa Webster. I'm Senior Technical Consultant here at AJ Bell. So today, starting talking about lifetime allowance dilemmas, this is just a topic that get asked about by quite a lot of advisors. We regularly get some queries about, what's the best thing to do in certain scenarios. So the first one, sorry about that, there's a slight technical problem there, we seem to be sorted now. The first one then, this dilemma we get asked about is regarding clients that are sort of maybe not retiring just yet, they're still in work, they've got quite a substantial pension fund and they're approaching the lifetime allowance. They may not have hit it just yet, but if you carry on funding for them, there is a real danger that they're going to breach the lifetime allowance and potentially have problems in the future. So the question we get asked is whether for these clients it's the right thing to do to carry on funding those pensions in the knowledge that you might have an issue in the future. So if we look at the arguments for and against, the argument for continuing funding, we start off looking at, obviously you get tax relief on any personal contributions going in, assuming of course that they do have sufficient annual allowance available. Now, working on the basis that most people who have a lifetime allowance issue are likely to be higher, if not additional rate taxpayers. So you're looking at getting 40, maybe even 45% tax relief on the way in. Obviously, if you're up in Scotland, you have slightly different tax rates. You might be getting 41 or even 46% tax relief on the way in. And once all those funds are within the pension, you're benefiting from the compound tax-free growth. So all obviously good reasons for to carry on funding. If you're looking at employer contributions, it might depend a little bit on the relationship with the employer, but certainly if you are in the circumstances where you either have an employer contribution, you either say yes or no to it, quite clearly you're going to say yes still, because effectively that's free money, even if you do get a tax charge on it on the way out. For those that have a bit more control of the business and able to sort of rejig their remuneration packages maybe to in other ways, maybe slightly different scenario. So yeah, tax-free, tax relief and contributions going in, tax-free growth once it's in there. But of course, on the way out, on the flip side of that, if you do exceed the lifetime allowance, then you are going to be hit with the LTA charge. Now, effectively, for somebody who is a higher or additional rate taxpayer in retirement, you're looking at a 55% effective rate of tax. That's because you have your 25% LTA charge when you put your funds into drawdown, and then at the point that you actually take it out, if you're paying 40% tax, the combined rates work out to be 55%. If you're additional rate taxpayer, or even just a higher rate taxpayer in Scotland, you actually become better taking the lump sum to give you the 55% effective rate, because otherwise if you pay 25%, put it into drawdown and then pay tax on that income when you take it out, you'll actually be paying a little bit more. For those that can manage their income to only be a basic rate taxpayer in retirement, then the effective overall rate of that 25% LTA charge and then 20% tax on the residual when you take it out for income works out as a 40% effective rate of tax. So, if you've got 40 or 45% tax relief on the way in and then 40% tax paid on the way out, but you've had compound tax-free growth in between, probably still worth considering. That is, of course, assuming that it is the member themselves who take the funds out in their lifetime. That's not always the case. Instead, if funds are still in the pension on their death, if they die before 75 and those funds are designated within 2 years of their death, then there's just the 25% lifetime allowance charge with no income tax for the beneficiaries. So again, funding for people that have health issues, might not make it to age 75, that does look more attractive in terms of, tax relief coming in versus tax on the way out. Post 75, if somebody, once they hit the 75th birthday, if they haven't already fully crystallised, then they will have the 25% tax charge deducted from their fund on any excess on their 75th birthday. but the effective overall rate of tax then comes down to depending on who the beneficiary is and their rate of tax. And again, you've got the effective rate of taxes there, combining the 25% LTA charge and their marginal rate of income tax. But you could also potentially have non-taxpayers in that category, which we'll talk a little bit more about that later on. The next scenario we look at, which may well apply to sort of the same client a few years later, once you've had sort of not so much the funding issues, the funds are in, you've got people that are at the point of retirement, you know, they're not putting any more money into their pension, but then the question becomes whether you start withdrawing that income or do you leave it in the fund to grow, knowing that if they're over the lifetime allowance, the more the fund grows, then the higher the lifetime allowance charge is going to be in the future. And it's certainly unavoidable if they live to age 75, or you know, if they crystallise or die before then, it would be tested beforehand. So the questions then really to sort of consider on this, if they are going to draw down income in excess of the lifetime allowance, is the income needed? What are they going to do with it? Some clients may be comfortable with the concept of making gifts out of income. Obviously, if you make regular gifts out of income, as long as you keep the sort of document it correctly, so you have the evidence of that, that should be outside somebody's estate. So there'll be no inheritance tax on that if people don't need the income. Pay the taxes on it, but pay it out. Obviously, the worst case scenario and the last thing you want to do is for people to withdraw pension from their funds, pay tax on it, and then leave it within their estate, and then so it's liable for inheritance tax as well as being taxed. But if somebody were to die before 75, whilst in drawdown, those drawdown funds don't get tested again against the lifetime allowance, and there's no income tax to pay for the beneficiaries. If you're in drawdown and all the growth is removed, then so you remove all your growth, then no further lifetime allowance charge will happen at age 75, and on death post 75, and the income tax, again, it'll be down to the beneficiary's rate of income tax. All of this is probably best explained, comes to life a little bit more with a case study. So we're going to have a look at a case study now. Sorry, just slight issues here. It's not letting me move on to the next slide. Apologies for this. Hopefully we'll get this sorted in just a moment. Right. Sorry about that. So here we have the case of Mrs. Smith. Now, Mrs. Smith is age 60. She's decided to stop work. She's got a pension fund of 1,255,000 fund there. She has no protection, and she does have other sources of income. And so the question that's being asked is really, does she strip the funds out before age 75? Because she's going to have a bigger lifetime allowance issue then, or is she better off leaving it invested? So we've been told in this scenario that she wanted to take her PCLS, take a maximum PCLS. In this circumstances, it was she wanted to help her children get on the property ladder. So her maximum PCLS this year with the current lifetime allowance is £263,750,000. So she takes that PCLS. In order to do so, she's fully crystallising up to the lifetime allowance, so she needs to put £791,250 into drawdown, which will leave her with an uncrystallised fund of the excess over her LTA of £200,000. So the question then really is, does she leave those funds invested, or does she draw it down to reduce her lifetime allowance charge at age 75? So first option then is to fully crystallise. So if she fully crystallises everything now, she will have the 25% LTA charge on her excess, which is 200,000. So that leaves £150,000 that's added to her drawdown pot, giving her a total drawdown fund of just in excess of £941,000. She would need to avoid a lifetime allowance charge at age 75. Basically, you need to withdraw all the growth. Now, looking on the fund value of that side, if you make an assumption of 5% net growth, net of charges, then you're looking at just over £47,000 a year, and she'd need to take that out every year. Obviously, the actual amounts are going to fluctuate depending on your fund performance, but she needs to withdraw that. Now, we've said in this scenario, the example we were given, that she does have all the sources of income. So on that amount of withdrawals, it's likely that at least some of it is going to be taxed at 40%. Some of it maybe even 45%. Even with state pension, it's going to push just a little bit of that into the 40% tax bracket. When she gets to 75, in her pension fund, her drawdown fund will be exactly the same if she's taken out all the growth. But in the meantime, in the 15 years from age 60 to her 75th birthday, she's going to have had just over £47,000 each year. So just over £700,000 been withdrawn in total over the period. So that means her pension fund, combined with all her withdrawals over the 15 years, you're looking at a total of just over £1.6 million. Now, obviously, bits she's withdrawn, she will have paid tax on that, and the bits in a pension fund, if she wants to take it out, she will be paying income tax on that at the point she withdraws it. Now, so that's the just over 1.6 million. That's if she fully crystallises. The other option, of course, she said if she doesn't actually need the income, is to leave those funds invested. If she leaves the funds untouched, and we make the same assumptions about growth, her drawdown fund and her uncrystallised fund, put those together, apply the growth on it, she'll end up with a fund of just over £2 million by her 75th birthday. When you do the LTA test at age 75, you get a credit for the amount previously put into drawdown, in this case £791,250, and it's the difference between those two which is then subject to the LTA charge of 25%. So you're looking at an LTA charge of just in excess of £317,000. It's a fairly substantial charge, and obviously one that you would want to make sure your client was prepared for. You don't want to be given that kind of news as a shock. But if you look at the total, then once that charge has been deducted from her fund, her pension fund, then she would still have in excess of 1.7 million. Again, point that gets withdrawn from the fund, obviously tax would be payable on that income tax as and when that is withdrawn, but it's worth noting that that is a higher value than if she'd been drawing down the fund, but it's not a significant difference. It's not a huge difference between the two, but it is slightly higher. Looking now to what happens when she passes away. If she passes away before age 75, and she's fully crystallised, then, she's crystallised some of her fund, but not all of it. There's only the LTA test on the uncrystallised element, which will, in this case, would be the £200,000 plus the growth on that, whatever that is, to the date of her death, and then no income tax if designated within 2 years to a beneficiary. If she dies post 75, obviously we've had the age 75 test where you'd have that £300,000 deducted. It wouldn't get tested again after that, and then when it's paid out, it would be income tax for beneficiary, which could be children, could be grandchildren. We'll come on to a little bit more details about beneficiaries in just a moment. So when you're talking to clients about the options of these lifetime allowance issues, whether you draw down, whether you leave funds invested, the sort of main points to consider really are, first of all, what are the sources of income does the client have? Obviously, if people need the income and they're going to be spending it and enjoying it themselves, then yes, you're going to take it out. A lot of clients will be, it may be sufficient to take out the income up to the lifetime allowance without crystallising the excess before they're age 75, potentially. The next question is sort of regarding their health and how likely is it that they are going to reach age 75. If somebody's in their 60s and you're looking at these scenarios sort of as a starting point, what is their health condition? That will be a big factor. The tax rate payable on withdrawals, whether you can manage income to just keep it within the basic rate tax band, whether that's not an option. Whether they want to gift money in their lifetime, you know, some people are quite happy to make gifts out of income and pass it on to family members whilst they're still alive, want to see them enjoying it as well. Other people less so, they probably want to sort of keep it, don't want to give the money away in their own lifetime. Another option to consider, which may work for some clients, is the option of the person who's got the lifetime allowance issue, so mum or dad, taking funds out, making withdrawals. They may be higher rate taxpayers potentially, paying their 40% tax on withdrawing the money from their pension, but using those to fund pension contributions for their children. If you've got clients who are in their 60s, maybe early 70s, you know, their children could easily be in their 30s or 40s, maybe higher rate taxpayers themselves. Now, providing the adult child has got sufficient annual allowance available and doesn't have any lifetime allowance issues of their own, which is less likely for that generation, then you could, you know, mum or dad could take some income, make gifts out of income, use those to fund pension contributions for their offspring, who they themselves would then benefit from the higher rate tax relief if they had sufficient income on that. And that's quite a tax efficient way of passing things on within the family. Obviously, yes, mum or dad is paying the 40% tax and the child is benefiting from it, but within the family it's tax neutral. And so as long as you keep the appropriate records and it's regular gifts out of income, then you shouldn't have to worry about inheritance tax. And it's a way of moving funds away from the family member who's got a lifetime allowance issue to move it to somebody that potentially doesn't have that issue, sort of moving the problem. So it can be quite a tax efficient way of moving things on. And some people may be a bit more comfortable about gifting money if they know their offspring aren't actually going to be able to get their hands on it until they're, you know, at least age 55. So maybe worth considering for certain clients. And finally, we're talking about, you know, funding, whether you withdraw money from pension for somebody with a lifetime allowance issue, is, you know, if they're not spending it all within their lifetime, you know, who are their potential beneficiaries? Look at their family members and sort of what tax band do their beneficiaries fall into, and sort of how tax efficient that could be. So looking at beneficiaries then, I've talked about beneficiaries and mentioned it quite a few times now, and it's sort of important to know the difference, you know what a beneficiary is and who can be a beneficiary. We're talking about beneficiaries in terms of pension death benefits and under pension freedoms. Beneficiary is somebody that can have the death benefits, they can receive the death benefits and keep it within a pension wrapper and use it to provide you know, flexi access drawdown. Beneficiaries flexi access drawdown, or they could, if they wanted to, use it to purchase an annuity. It's not available to anybody. Scheme administrators do have discretion in order as to where death benefits can be paid, but if somebody isn't a beneficiary, even though the scheme administrator can sort of exercise their discretion and pay it to somebody, pay death benefits to somebody that isn't a beneficiary, they would only have the option of doing so as a lump sum, not for the benefits to be kept within the pension wrapper. And that can be a lot less tax efficient, particularly, you know, the bigger the fund you have. So if you had a £500,000 fund, somebody can be a beneficiary, have it as flexi access drawdown, keep it in the tax advantage wrapper, just take income as and when they need it, manage it within tax brackets, versus somebody who has a £500,000, only has the option of a lump sum. They're going to be paying 45% tax on most of that, so 46% if you're in Scotland. So it really can make quite a big difference. So in terms of beneficiaries, who can be beneficiaries, how that works. If we have a member of a pension fund, first beneficiary, most obvious one if you like, it would be the dependent. In this case, we've got the member's wife. A dependent is always a potential beneficiary, whether or not the member nominates them. So if they have a spouse or civil partner, they will always be a dependent. If you have a child under the age of 23, if you have an older child due to physical or mental impairment who's dependent on a member, people in relationships of financial interdependence, they can be classed as a dependent, and the scheme administrator will always have the ability to use their discretion as appropriate, pay benefits to them, death benefits to them, and they will have the option of, you know, flex access drawdown, being able to keep it within a pension fund for a dependent. For anybody else to have it, they have to be nominated. So For example, adult children, they're not going to be classed as dependents if they're over the age of 23, generally speaking. But the member can nominate children. That's absolutely fine. They will be classed as a nominee, though not a dependent. It doesn't have to be a family member. If your pension member wants to put his pal from down the pub or whatever, his friend or anybody, that's absolutely fine too. They can make a nomination. They would be eligible to be a beneficiary as long as the member nominated them. Death benefits now, they don't always, they don't end on the death of the member. Things can be passed on again. So for example, here, if the daughter inherited the pension fund, had its flexi access drawdown, and there were still funds left when she passed away, she could pass them on again. And that type of beneficiary would be classed as a successor, because it's after a beneficiary's death or a subsequent death. Now, even though that is a child, it's not a dependent of the original member, so there's no classification of a dependent of a beneficiary. The dependent category only applies to the original member. But of course, the member does also have the option. Grandad here could have nominated his grandchild directly to receive some benefits, which sort of in the context, go back to lifetime allowance dilemmas and tax efficiency, could be a very efficient option to have some benefits in pension left directly to a child who is a non-taxpayer. They can still have pension benefits, that's absolutely fine. They could have, for example, a junior SIP, which is managed by their parents. Withdrawals can be made at any age as a beneficiary, as long as it's for the beneficiary's benefit. So, for example, you could use them to pay school fees, is an obvious one on that. So, because of the sort of the rules around beneficiaries and the tax advantage of being able to keep it as a beneficiary's drawdown pot opposed to having the option of paying it a lump sum, we've sort of changed our nomination form when the rules changed. Some of you, I'm sure, will have seen this before. There are only very limited circumstances normally where a scheme administrator can make a nomination, and that is where there are no dependents of the member and the member has made no nomination. So basically we have to have nothing at all from the member and for them to be no dependents for an audit for a pension scheme administrator to be able to make a nomination. So sort of scenario might be where there's husband, wife, you know, maybe a couple of kids, husband dies, he's only nominated his wife to get 100%. But she actually has some funds in her own right. She's got other sources of income. She doesn't need it. She actually wants some of it to go directly to her children. Now, in those circumstances, if he's only nominated his spouse, we would only have the option. We could use our discretion if all parties agreed and it's appropriate, etc. We could exercise our discretion and pay some benefits directly to the children. But because they weren't nominated, they would only have the lump sum option. However, with our form, if one of our forms had been completed, we would actually be able to, they would be able to receive flexi access drawdown. And that's because in our section here, we have our nomination section, which actually defines any individuals who are eligible benefit recipients as per our scheme trust deed rules that we can allocate them. So that's like the legal nomination bit, and I'll come on to what that definition is in just a moment. And then underneath it, you have your expression of wish, where you tell us who the member tells who they actually want the benefits to go to. So in the scenario we just looked at it, he might have put 100% to his wife and that one, but because of the nomination section, if we look at the scheme rules, it actually says on here that we can pay benefits to anybody who is the members, their grandparents and their grandparents' descendants, including step and adopted descendants and their spouses. So it makes it a really sort of wide net of basically any family members are included in that. So because of that, if one of our forms has been completed, we can use our discretion, we can pay to other family members even if they're not actually nominated. But it's worth remembering the rules because obviously not all providers operate like that. And if they're not been nominated, then you won't have that flexibility. I know a lot of you probably might have used the method of sort of writing, you know, 98% spouse, the 1% child, 1% child, which is fine. And then the scheme administrator can vary those percentages if it's appropriate, and that does work. You know, there's not a problem with that, but obviously they do have to be named, so you do sort of need to be a little bit careful with that. Final point on beneficiaries then, a couple of reminders. First of all, that beneficiaries funds are always kept separate, so you can have one SIP, for example, which will have members funds and beneficiaries fund all in the same wrapper. That's absolutely fine, but they'll have separate arrangements within that wrapper, so we can distinguish which are the member funds, which are the beneficiaries funds. Taking an income from beneficiaries funds doesn't trigger the money purchase annual allowance, so it's definitely an argument for using beneficiaries funds first. You know, they also may have a scenario where your beneficiaries funds are tax-free if the deceased member they've inherited them from was under the age of 75, whereas obviously if you take any income from your own funds, then they are going to be taxed. No impact on the lifetime allowance of the person receiving the funds. So it doesn't matter if that person has got protection, it doesn't matter if they've got lifetime issues or potentially lifetime allowance issues of their own. It's not going to have any impact. It's never tested against their own lifetime allowance. And I touched on before, yes, you can have junior SIPs, so you can have pensions for minors managed by the parent, legal guardian, access money whenever you want from it, as long as it is in for the beneficiary. So school fees is an obvious one. Our junior SIPs now, we don't have any wrapper fees on our junior SIPs, and so they sort of makes it still cost efficient to have them. And then when they reach 18, then they just turn into an adult SIP, and usual fees apply on those. Okay, moving on now. So this statutory permissive override, this is just something to be aware of. When pension freedoms came along, it's fair to say, I think it caught everybody in the industry a bit by surprise. The changes were a very last minute and a big shock to everybody when it all came out. And because there wasn't a big time window for providers to prepare for pension freedoms, what the government did is they put in a statutory permissive override in legislation which allows pension schemes, any defined contribution pension scheme, to offer pension freedoms without it having to be written in their scheme rules. And this includes death benefits. So any defined contribution pension scheme can offer beneficiaries flexi access drawdown. It does not have to allow it in their rules. It doesn't have to be written in it anywhere because of this override. And that's of interest because we are certainly aware of there's a number of providers out there who will have personal pension contracts, things like retirement annuity contracts, Section 32s, etc., where when the member dies, they will tell you that the only option available to you for the death benefits is either a lump sum or to purchase an annuity, because they don't offer flexi access drawdown for the beneficiary. And sometimes it might be in the beneficiary's best interest to have flexi access drawdown. They can do it. The other objection you will normally find, other than saying that their scheme rules don't allow it, is that their systems don't allow it and they can't process it. The short answer is they don't have to be able to process it, because all they need to do is designate the funds to drawdown, and then you can do a like-for-like transfer to a provider that can actually facilitate it and make the payments. So if you have any of these scenarios, for your clients, and you get told that by a provider, I would say that it's worth going back and questioning them. We have had a few circumstances we've managed to make people change their minds and persuade that we can do it. All the receiving scheme would need in order to be able to accept the transfer from such a scheme would be confirmation, so written confirmation that the funds have been designated into the beneficiaries flexi access drawdown in the beneficiary's name, the date that they were designated, and whether the funds are taxable or not, which will be based on the age of the deceased member at the time of death. And then just on the bottom of the slide there, I've got about the override. That's where you can find it if you get questioned on it. Section 273B of the Finance Act 2004 basically states that schemes can offer this. Okay, I'm just going to finish off with a little bit about inheritance tax and pensions then. The Office of Tax Simplification had a call for evidence report last year looking at inheritance tax in general, but with a couple of sort of elements in it where they did touch on which relate to pensions. They had a first report out it was November last year, and then they had the second report out in July, which is a bit about pensions. So first of all, looking at serious ill health transfers, again, this is an area you get asked about a lot, and understandably, because it's very unclear, as we will see. So the situation is, if somebody makes a transfer, a pension scheme transfer in the 2 years prior to death and the member was in ill health, then potentially it could be liable to inheritance tax. Now, in terms of the 2-year window, in legislation, there isn't a 2-year window at all. You know, if somebody transfers with ill health, then potentially it could be liable to inheritance tax. However, in practical terms, it's only over the last 2 years that are looked at, because when somebody dies, you have to report any transfers made to the pension scheme within the last 2-year period on the IHT 409 forms. So those are the ones which are likely to be picked up. We've spoken to HMRC several times about this, trying to get a bit more clarity. We had some correspondence with them earlier this year, and they referred us to an Inland Revenue Tax Bulletin dated 1992, which is, you know, a few years ago now, but they are still referring to it, and this is still, they've told us, you know, this year that this is still their stance. And they've said there's no question of a claim being raised in cases of genuine pension arrangements where it's clear policyholder's primary intention is to provide for his or her own retirement benefit. So really what they're saying is that, you know, if you can show that the reason for you doing the transfer, even if the member's in ill health, is for their own benefit, then IHT shouldn't apply. So, for example, if you're transferring it so they can access flexible benefits, for example, which they can't do under their, you know, their existing scheme, you know, if it's different investments, service issues, whatever it is, if it's doing something that will benefit them in their lifetime, then inheritance tax shouldn't apply. The Office for Tax Simplification review commented on this and said it was very unusual for HMR to argue there's been a transfer of value. Did say that HMRC will only argue the case if there is evidence of an intention to confer a gratuitous benefit. So really that's when somebody's transferring, most commonly from a DB scheme to a PP, where they don't have any dependents, so that if they die in the DB scheme, there will be no death benefits. And when they transfer across, obviously there'll be some death benefits they can leave to somebody else. I mean, that's probably the clearest cut example of where you would do it. And even if inheritance tax does apply, you know, there's still definitely an argument for doing it in that scenario, because, you know, getting something rather than nothing can be of benefit. The amount that's subject to inheritance tax, there might not be as much as you thought. So we'll have a sort of little look at that again with another case study. So the example I've got here is John, who is terminally ill. He's got a £500,000 transfer from a retirement annuity contract to a SIP, and he dies within 12 months of transfer. Now, HMRC have said how they sort of work out the transfer of value is they look at the open market of the death benefits before the transfer, less the open market of the lifetime benefits after the transfer. And so they look at this because if you're in good health at the point of transfer, then your death benefits are going to be worth very, very little, because the idea being you're healthy, you will use your pension in your lifetime, and there'll be very little left on your death. Whereas that changes, obviously, if somebody's in serious ill health, the death benefits become much more valuable. So the open market death benefit then in our example then, we're going to say that the value is close to the transfer value because he was in very poor health. So let's make an assumption of £480,000 after the growth and the discount rate. I've seen various examples of this where different discount rates used. The 7.5% discount rate I've used in this example is one that HMRC used on an example to us, so that's where I've got mine from. So that's the open market value, and then you subtract from that the open market value of the lifetime benefits, which under pension freedoms, the maximum you can take out is going to be a UFPLS payment. So you're going to get that 25% of that tax-free, and the rest of it will be subject to income tax. So looking at that after tax, your open market value of your lifetime benefits here are 335,000. So the deemed loss to the estate then will be the open market death benefit of 480,000 less the 335,000. So the deemed loss to the estate is 145,000. So that's the amount that would be subject to inheritance tax at 40%. So it's not the whole fund value. So there is still a liability there, but it's maybe not as huge as you may have thought. Other question we get asked on this quite a bit is about spousal exemptions. And spousal exemptions don't apply, and that's because even though the inheritance tax liability isn't going to arise until after the death has happened, potentially it should have arisen at the point of transfer, so it is a chargeable lifetime transfer, so therefore there is no spousal exemption. So you know, if you are doing a transfer, benefits against the spouse, that's not a get out clause, unfortunately. You do still need to consider it. Another point sort of worth mentioning is I've been sort of talking about this, you know, and giving these examples for a little while in various talks around the country, and I've had at least 4 different advisors come up to me and say they've had scenarios where they have done a serious ill health transfer for the death benefits, DB to personal pension. They've done it. Some of them are sizable funds. One of them was in excess of £1 million. They've reported it on their HT 409 forms to HMRC, and then they've heard nothing. And you know, some of those that the estate has been completed, it's all been finished, everything's been wound up, and HMRC have never come and applied inheritance tax on them. So even in some quite clear-cut scenarios where you really think it would apply, it does seem that that's not always the case in practice. Obviously, you know, when you're sort of making your recommendations, you need to take into account that, you know, it is certainly possible that inheritance tax can apply, but it just in practice it seems that's not always the case. So definitely unclear. Going back to the Office for Tax Simplification, OTS have said that they consider it be helpful if HMRC were to provide further detailed guidance on the circumstances in which a gratuitous benefit may arise when making certain pension transfers, such as from a DB scheme to a personal pension shortly before death. I think we can all agree on that definitely needs some clarity, because it's really not clear cut at the moment. And then one final point to mention on this from the report, they've stated their view that the interaction between IHT and pension is clearly a complex area, and that they think it is appropriate at some point in the future for the government to consider a wider review of tax and pensions, and possibly, it seems like they're volunteering themselves, the OTS may look at that one in the future. So really that's sort of one to watch on there. Right, well that's all from me for this morning. Thank you very much for those of you that have listened through to the end. The webinar will be uploaded onto our info centre on our website. The CPD certificates will be emailed out to you. For those of you that have asked any questions, apologies, I don't have time to go through many questions now, but if we have received those, then either myself or one of my colleagues will get back to you. We'll try and get answers out to all of you on any questions that have raised. Thank you.